African aviation recovers despite second wave. Air traffic on the continent is recovering faster than other regions around the world despite a devastating second wave, according to the African Airlines Association (AFRAA). While a sharp increase in COVID-19 cases in several more developed markets have sparked a return to lockdown, most African countries have kept their borders open, even as the continent suffers from a second wave and a death rate above the global average. South Africa returned to stricter lockdown after being hit by a more transmissible strain of the virus, which has spread to at least 3 other African nations. Despite mounting concern over the severity of the second wave, travel within the region has continued at a reduced rate. The demand remains high, and we have seen that the intra-Africa traffic is starting to recover at an even quicker rate than other regions in the world, says Abdirahman Betha, AFRAA Secretary General. Domestic markets have been at the forefront of this recovery as local flights take up an increasing share of overall air travel. From January to November, domestic travel in Africa accounted for 43.7% of total capacity and 52.8% of total traffic, says Bethe. Europe's aviation industry is feeling the burden of the coronavirus crisis more severely than other regions, with seat capacity down by 55% this year, a rate that is worse than any other region. While large festive celebrations were impossible for many European and North American families over Christmas, Africans continued to travel within the region during the same period. However, international flights remain far below pre-pandemic levels, while at the same time showing a slight recovery. In Africa, AFRAA recorded that African Airlines had resumed 68.4% of international routes, while passenger numbers were around 50% less than before 2020. In just one example of reduced routes, Kenya Airways KQ announced last week that it will temporarily suspend flights to Amsterdam and France due to depressed demand. Despite a faster pace of recovery, industry losses have mounted to $10.4 billion in January, according to AFRAA. Most African airlines were losing money even before the pandemic, says Bethe. Most of them risk going bankrupt if adequate support is not given as soon as possible. The African Union had proposed $25 billion to bail out struggling African carriers last year. Bethe says that this money has been very slow to materialize, though he hopes it will be secured during the first quarter of 2021. Dampening the sector's outlook further, Western countries have slapped travel restrictions on passengers coming from African countries. On Tuesday, the White House imposed a new travel ban on South Africa over its virus variant. Earlier in January, the UK banned passengers coming from or via any South African country in the last 10 days, including Namibia, Zimbabwe, Botswana, Eswatini, Zambia, Malawi, Lesotho, Mozambique and Angola, as well as Seychelles and Mauritius. With the continent's inadequate healthcare infrastructure unable to support a comprehensive vaccine rollout, Africa's aviation recovery will likely be short-lived if cases rise rapidly and South Africa's virus variants become more widespread. African agricultural sector continues to draw high interest from investors. The trade and investment landscape in Africa has continued to draw interest from lenders, particularly in West Africa, with notable changes in origination strategies. In quarter 1 of 2021, Orbit reported a 26% increase in the number of unique inquiries from lenders originating funding opportunities when compared with the same period in 2020. Some lenders have seemingly decided to focus more on particular regions and, in some cases, individual countries, citing due diligence processes disrupted due to travel restrictions as a main reason, and risk mitigation strategies as the second most common reason. These have prompted lenders to focus on regions and/or countries where they have representative offices or a deep and reliable network. Agriculture remains the sector with the most interest, present in almost 70% of investor mandates. Financial services and manufacturing, including FMCG, are also quite prominent, being flagged as sectors of interest in 64% and 44% of investor mandates respectively. 231 unique lender inquiries were recorded in Q1 of 2021. Of these, 58% of the companies are either headquartered in West Africa or have their main operations in West Africa. 17% are based in East Africa and 16% are based in Southern Africa. Only 5% of these companies have cross-regional operations compared to 14% recorded in Q1 of 2020 pre-pandemic. A considerable portion of the lenders' inquiries included a working capital component in the proposed transaction structure, 35%. Supply chain finance and asset financing components were also notably present in discussions, 34 and 30% respectively. This quarter, the average ticket size was recorded at $12 million, an increase from the $10 million average recorded in the same time period in 2020. 20% of the companies receiving inquiries from lenders reported annual revenues between $100 million and $250 million, and a further 13% reported annual revenues of about $250 to $500 million, showing lender appetite for the larger companies. However, a considerable amount of inquiries were received by companies reporting annual revenues between $1 and $5 million, particularly from the more impact-focused lenders. The orbit perspective. Africa-focused lenders may have adjusted their origination strategies this year, with international lenders working around travel restrictions and disruptions to due diligence processes. But activity on the continent continues to increase. Lenders are considering larger transactions and employing additional credit enhancements to mitigate perceived risk in transactions.